The 2008 financial crisis was one of the most significant economic events of the 21st century. Triggered by the collapse of the U.S. housing bubble and fueled by excessive risk-taking in the financial sector, it led to a global recession, widespread job losses, mass foreclosures, and the evaporation of trillions in wealth. But beyond the pain and panic, it also left behind valuable lessons, many of which are just as relevant today as they were over a decade ago. Whether you're a seasoned investor, a new entrepreneur, or someone trying to build financial stability, understanding the root causes and takeaways from the 2008 crash can help protect you from repeating history. Here are the top 10 lessons from the 2008 financial crisis that still hold strong today. 1. Always read the fine print, especially with loans. One of the biggest triggers of the 2008 meltdown was the subprime mortgage crisis. Millions of Americans took out loans they didn't fully understand, particularly adjustable-rate mortgages with teaser rates that exploded after a few years. Many were sold on the dream of homeownership without understanding the risk. The takeaway? Never sign a loan agreement without fully understanding the terms, especially when it comes to interest rate changes, balloon payments, or penalties. Whether it's a car loan, a student loan, or a mortgage, fine print matters, and ignoring it can be financially devastating. 2. Debt is a double-edged sword. Credit can be a tool, but in 2008, it became a weapon of destruction. Consumers, banks, and corporations all became over-leveraged. When the economy turned, debt amplified the losses. Households that had borrowed against their homes suddenly owed more than their houses were worth. Businesses that expanded with borrowed money collapsed when cash flow dried up. The lesson is clear. Use debt carefully and sparingly. Maintain a low debt-to-income ratio and never assume your current income is permanent. Just because a lender offers you a loan doesn't mean you should take it. 3. Diversification is non-negotiable. The crash proved that putting all your financial eggs in one basket is a dangerous strategy. Many investors were heavily invested in real estate or specific sectors of the stock market. When the housing and financial sectors collapsed, portfolios were wiped out. Diversification across asset classes, stocks, bonds, real estate, cash, and even geographic regions, helps cushion the blow during downturns. Spreading your risk doesn't eliminate it, but it makes you far less vulnerable to sector-specific disasters. No matter how confident you are in an asset, never bet your entire future on it. 4. Emergency funds are financial lifelines. Millions of people lost their jobs, homes, or both during the Great Recession. Those who had emergency savings fared significantly better than those living paycheck to paycheck. The ability to cover 3 to 6 months of expenses can mean the difference between temporary discomfort and financial ruin. The lesson: always prioritize building and maintaining an emergency fund. Even when things are going well, resist the temptation to spend your entire income. Save consistently in a separate, accessible account to protect yourself from unexpected job loss, medical expenses, or economic downturns. 5. Financial literacy is your greatest asset. A significant factor behind the 2008 crisis was a lack of financial literacy, not just among consumers, but also among professionals and policymakers. Many people didn't understand how risky certain mortgages were or how credit default swaps worked. Today, there's no excuse for being uninformed. Resources are everywhere: books, podcasts, blogs, and financial advisors. The more you understand about credit, investing, saving, and budgeting, the better prepared you'll be for market volatility. Financial literacy empowers you to make smarter choices and avoid manipulative schemes and bad investments. 6. Regulators can't protect you from everything. One of the hardest lessons from the crash was that regulators failed to prevent the crisis despite warning signs. From weak oversight of financial institutions to the blind eye turned toward predatory lending, systemic problems festered. While regulations have improved since then, they're not foolproof. Don't assume someone else is managing the risk on your behalf. Do your own research. Whether it's a mutual fund, a bank, or an insurance policy, verify its credibility and understand how it works. Personal accountability is crucial in a world where oversight can still fall short. 7. Greed is not a strategy. Greed, by individuals, banks, corporations, and investors, was the underlying emotion behind many of the bad decisions made leading up to 2008. People wanted bigger houses, higher returns, and instant wealth, and many were willing to ignore risk or ethics to get there. But when the bubble burst, the consequences were massive. Chasing returns without a solid foundation is a fast track to financial disaster. The smarter approach is to prioritize sustainable growth, long-term investments, and smart budgeting. Steady, patient strategies always outperform get-rich-quick mindsets in the long run. 8. Job security is an illusion. During the crash, even people in safe professions, engineers, bankers, teachers, found themselves out of work. Entire industries contracted or disappeared. It reminded everyone that no job is guaranteed, and you should always be prepared for change. The lesson here is to invest in yourself constantly. Upgrade your skills, build a strong professional network, and maintain side income streams if possible. Having multiple ways to earn money makes you more resilient to economic shocks and job market volatility. Never put all your eggs in one employment basket. 9. Don't underestimate the ripple effect. What started as a housing problem quickly escalated into a global financial crisis. Banks failed. Stocks plummeted. Governments bailed out industries. The lesson is that everything in the financial world is interconnected. If one area, like real estate or credit, goes down, it can drag others with it. Investors today need to understand these ripple effects. Always ask, how could this decision affect my other assets, my job, or my business? Pay attention to economic indicators beyond your own circle. A smart financial strategy accounts for systemic risk, not just personal gains. 10. Crisis equals opportunity, if you're ready. While many people lost wealth and security during the crash, others saw opportunities to build generational wealth. Those with cash reserves bought stocks at historic lows, snapped up foreclosed properties, or launched businesses while competitors were retreating. The key difference? Preparation. People who stayed liquid, avoided overleveraging, and maintained a long-term mindset were able to act while others panicked. Every crisis brings chances to pivot, invest, and grow, but only if you've kept your foundation strong. Always keep some dry powder for the next downturn. It's not a matter of if, but when. The 2008 financial crash was devastating, but it was also educational. It revealed the cracks in our economic systems, personal habits, and assumptions about safety and growth. More importantly, it reminded us that no matter how stable things seem, risk is always present, and preparedness is non-negotiable. Today, with rising inflation, shifting job markets, and growing debt levels, many of the same warning signs are appearing. But armed with the lessons of the past, you don't have to repeat the same mistakes. Stay informed, stay diversified, and build a resilient financial life that can withstand any storm. The next crisis may look different, but the principles for surviving it remain the same.